All right. What is going on, everybody? As Brent mentioned, we are getting into our final discussion of the day. We're going to be talking where real estate fits into a post-pandemic portfolio. We're joined by Aaron Halfacre. Halfacre, real last name, very fitting for being in the real estate business, CEO over at Motive. Aaron, thank you so much for hopping back on with us today.
Luke, thanks for having me again. I appreciate it. Looking forward to this discussion.
Absolutely. So let's get started with the question that basically is at the heart of the title of the discussion that we're having. But we're sort of getting into this reopening world and beyond this reopening phase. Can you talk about where you see investors gravitating?
Yeah, absolutely. If you don't mind, I'd like to answer it from a broader perspective and then drill down to real estate because,
Yep.
I've been a student and a participant in the capital markets for nearly 3 decades. When I was at BlackRock, I did real estate, I did fixed income, I did equity. I've taken a company public, I've taken it private. So I really love the interchange of the capital markets. And so it's so interesting to see these different times, and particularly last year, we think about COVID and its impact on, the sell-off in markets, and thinking about real estate and how did we see investors of different types start to re-enter, right? And we've started to see that over the last, call it 9+ months. And what I think I've certainly noticed is a risk on trade, right? So we're in a low rate environment. People are clamoring for yield. They're clamoring for total return. And we've seen a risk on trade. So that means people have gone out on the risk spectrum to find things that can generate the yields that they want to meet their financial objectives. Right. So generally speaking, it's a risk on trade. We've seen it cycle through different things. We've seen it cycle through some tech. We've seen it cycle through crypto. We've seen it's got a sort of a high volatility factor to it. Of that risk on trade environment, I've seen 2 different types of investors. Those who are able to discern and find mispriced securities. So there's an oversell environment and they come in and then they're getting in. So they're really early adopters. And then those who, after the trend has been established, are coming in, which reinforces the trend. Right. And so I think both of those camps are valid investors and they both have different objectives. Right. So typically a lot of the early adopters, the ones who are finding mispricing, are going to get in and they're going to get out once we've got the other ones coming in. The other ones are coming in for a little bit longer hold period. And then so they're participating in those benefits.
And that first group of investors that you're talking about, are those typically folks who are more experienced or is it across the spectrum of experience levels? Yeah.
And I think experience to me is someone who's willing to do the homework. So you can have experience by having done it for 20 years. You can have experience because you're finding your niche, you're focusing in on it, and you're doing the homework. I mean, you're participating in, events like this. You're doing a lot of online research. There's different ways to get experience. And there's some who have that sort of intuitive sense that, hey, I think there's something here. I'm going to place a bet in it. I'm going to go, or place a position in it, and then I'm going to see where it goes.
Okay. And like you're talking about sort of the investors moving into the market. Mm-hmm. A big trend that we've seen over the past 18 months, let's call it since April 2020, is a wave of those really new investors, right? It's folks who are getting involved in the market for the first time. There's still a lot of folks who we know because we get 15 million readers a month on Benzinga.com who are on the sidelines still waiting to get in. Any advice or tips that you can share for folks who are just getting started with investing as a whole?
Yeah, I've talked about this with our investor base. And so, just by example, Motive is a not yet listed company. It's publicly filing, so everything is transparent, so you can do that research, but it's not yet listed. And we have over, we're small compared to a lot of them. We have over 7,500 investors that we raised directly ourselves. So everyone who came in came on through basically without a broker online. It's just because we're not listed yet. And we control nearly $500 million of real estate assets. And so I've talked to a lot of those investors because a lot of them are saying, look, I'm a first-time investor. I want to own real estate and I kind of, how do I get about it? And I'd say the first journey when you're making investment decisions, even if they're speculative investment decisions, is to separate the emotion from the logic, right? So there are times when it's better to be Spock when you're investing, and there's other times when it's, just know that you always have emotions, that you're going to have an emotional bias when the share price gets volatile. You're going to have an emotional bias on what you think the outlook is. There doesn't mean it's bad. You just have to be cognizant of what the emotion is. And so oftentimes we are making investments, certainly for the first time, on emotional reasons. I want to turn $5,000 into $50,000. That's more of an emotional reason than a logical reason, right? Or
I've been there.
Yeah, exactly. We all have been, right? And when you buy a position and it goes down, you're like, oh, this is not what I want to do, and then you get emotional. You have to have done your research. So I try to say separate them. The second thing I tell people is make sure you have a game plan, right? So know what your goal is. If your goal is to speculate and learn by doing this at-risk money, so this is money that you don't mind getting burned up and you're putting positions on, learn, that's good. Know what it's for. If you have another set of money that you want to use for a down payment in 6 months, or you want to, you got a lease renewal or whatever on your car, you want to set that aside, then don't play with that, right? So know what your goals are for your different buckets of money. And then the last thing I'd say is make sure that you always have a bucket of money that makes you feel peace of mind, right? So you hear like Susie Ormans of the world, they always say to have emergency funds. I think there's validity in that. Not so much that you need all this money cash sitting there idle, but you need that calm and that patience to know that if this bucket of money here that's speculative goes to zero, that I'm not going to have to panic about how to pay my car payment or pay my rent or eat, right? And so I think it's important to separate those.
Okay, and so that's your advice for people who are newer and just getting started in the investment world. Yep. You've been around for a while. You've done a ton of transactions. So, Aaron, any advice that you have for folks who are more experienced to take sort of their investing profile up to the next level? Yeah,
I'd say, from my years of investing experience, that there are going to be great ideas that come and go. There are going to be great ideas that were absolutely great, and you'll hear them and they make a logical sense, but the market just doesn't work for them. Those ideas. I think the key when you're investing, you're giving your money to someone else. And that's ultimately what you're doing when you're buying a stock, a piece of real estate, or a mutual fund, anything. You're giving your money to someone else and you're saying, manage this. And even if it's like the CEO of IBM, they're managing, they're taking this money and they're doing something with it, right? I think the key is make sure you have a good leadership team. Make sure you understand that they know what they're doing. Make sure they're highly ethical. Make sure they're transparent, so that if you have ups and downs in the events economically, which you are always going to have, that they're transparent about them and that you think they have the skills to weather those storms should they arrive.
Okay. And I want to talk a little bit about how real estate fits into an investment portfolio. I think there's a lot of people out there, myself included, who have a portfolio that's consists 100% of stocks, mm-hmm. right? I'm a stock market investor. I do buy ETFs. I do stock picking. I haven't spent a ton of time considering how real estate could be a part of that investment portfolio. The first thing that comes to mind for me, and I imagine a lot of other folks, is it's more of an income type play. One is that necessarily true? And then two, just how should we think about real estate as a part of our broader investment portfolio?
Yeah, it's a great question. So real estate as an asset class is measured in the trillions. It's a very large asset class, a very hard asset, huge. Not very much of it is publicly traded. A lot of it is in the hands of private investors. The price behavior of private real estate is very different than the price behavior of public real estate. What I mean by that is, for instance, if you have a shopping center or an apartment complex and you owned it privately, it's not going to fluctuate in price. It's not going to be volatile in price. If you owned a shopping center REIT that was publicly traded or an apartment REIT publicly traded, it would trade very much like the small mid-cap names that it is, right? So because it's getting included in an ETF, because it's getting index inclusion, it's going to have volatility parameters that are different than the actual underlying asset class. That's what's unique about real estate investing. Why would you have real estate investing? Well, the non-correlated returns help diversify your portfolio, right? So we're all familiar with sort of the Yale endowment model, foundation endowments, where they go and they allocate stocks, bonds, and then alternative asset classes, the biggest being sort of real estate, traditionally being private, non-correlated real estate. And what it does is it diversifies your return profile. If you go back to the 08-09 crisis, you saw where equities crashed and real estate didn't, and it was a counterbalance, right? That being said, most of the real estate investing vehicles that you're going to find access to are going to lean heavily towards income, right? Because if you're doing development type of real estate, it's really speculative and there's no income and there's, it's a sort of couldn't be a binary outcome. And it's usually the advanced capital markets prefer to have an established property. So it's already income producing. Maybe you have the chance to boost the yield and it gets better. The dividend rate can get improved.
But I mean, that sounds like 90% of REITs that I know, what you're describing.
And that's interesting enough, because it's a REIT, an IRS tax election, the REIT mandates that 90% of your income, taxable income, get distributed. So you have to have taxable income to distribute it to be a REIT. So you'll find REOCs, or real estate operating companies. They might be land bank companies, or they might be things like that. So they're not qualified as REITs. So they may not distribute it, but they might have the opportunity to grow more and therefore have less income. You have home builders as an example, not the same kind of, it's correlated to real estate in the sense that they're building on real estate, but you're not actually owning real estate. They're selling inventory as a service.
Okay.
Yeah.
So let's go one step further, I guess, sort of along the investment path. So let's say we're at the point where we want to take a crack at some of this real estate investing that you're talking about, right? Let's go beyond the REITs. Let's look at some of these other real estate assets that are out there. How does somebody know where to start? What sorts of things should we look out for? What are red flags? What are signs that something is promising, et cetera?
Yeah. So access is the first thing you think about. So you're thinking about, how do I get access to this, right? So you can go, and the sort of the prototypical model is, I'm going to house hack. And so I'm going to buy a duplex and I'm going to live on one side, I'm going to rent out the other side, right? And then you're suddenly dealing with toilets and tenants and trash. And you're suddenly saying, well, this is not like my Robinhood application, right? This is not fun. And so you have a whole lot of people who started out that way and they're like, not me. And they get out. The next stage is sort of real estate crowdfunding, I think, is the easiest way. So there's a lot of different purveyors out there, Motive, CrowdStreet, Fundrise, Real Crowd, Cadre, all of them. They offer different real estate securities. That's effectively what they're offering. These might be LLCs. They may not be public. They may not be liquid. They may not have transparency. They may not have 1099s, but they are providing real estate and someone else is doing the managing for you. So you can get the income and the non-correlated benefits. From there, there's all the, I think you have different types of vehicles in there. So the ones that are more and more like what you're used to, if you're a stock investor, is those that are probably going to be private REITs or private funds that have public filings. So they have Qs and Ks. So if you can look them up, they might have earnings calls. They have corporate governance bells and whistles that you're used to. Then those are going to be the ones that are going to be the most familiar, but giving you the benefits of real estate.
Okay. That's helpful. And let me just keep digging on this thread if you don't mind.
Sure.
So we talked about how real estate could fit in. And then we got to, what sorts of things to look out for if we want to invest in real estate. Let's go even deeper. Are there certain categories of real estate that have been especially hot? And this is going back to, this question is going back to sort of the reopening theme, right? Are there certain categories that have been especially hot or certain categories that you think have been overlooked by investors?
Yeah. So if you think about the asset type, so in real estate parlance, we talk about sectors. And so the sectors are, they're asset type sectors. So you have multifamily, and this can be largely apartments. Now is an emerging trend is SFR, or single family rentals. So a large portfolio of individual homes. So that's again in sort of the housing category. You have senior housing, which is 55 plus communities. You have student housing, which is effectively just housing for students near campuses. And that's the housing sort of silo. Then you have offices. You have sort of midtown and urban and tertiary markets. Retail assets can be single tenant Walgreens, or they can be shopping centers, or they can be malls. So it's very diverse. You have industrial is warehouses. It could be manufacturing, things like that. And then you have what are sort of tertiary or niche sectors, even though they're fairly large and popular: self-storage, data centers, casinos, entertainment properties like movie theaters. So if you think about the spectrum of all that I just laid out and what's happened over the last sort of 9+ months, multifamily's done well. Why? Because rates are low and everyone wants to own and home prices are up. So multifamily has done relatively well. It's been relatively benign. So there are pricing opportunities there, but not a ton of them. Net lease assets, which is what Motive is and what Realty Income is, and those, they actually suffered a severe sell-off right after COVID. And now you start to see them rebounding. You're starting to see M&A activity and consolidation. So I think there's opportunities in the net lease sector. Retail shopping center. Yeah.
Really quick, let's just stay on net lease for 1 second before you get onto the retail. Yeah. You talked about we're starting to see some of that rebounding that's happened after that sharp COVID drop. Mm-hmm. How far along that rebound are we?
I'd say depending on the name, you're probably at least 50% on the rebound. And some of these I think are gonna if you take a beach ball and you push it below the surface of water, it pops back up and it goes above. And so I think we're going to see some of these who have actually strong fundamentals, and rates are so low that they're not only going to rebound, they're going to exceed the rebound. So I'd say some of them are 50%, some of them are 2/3, some of them have a lot more to go.
All right, awesome. Yeah. That directional context is certainly helpful.
So I think definitely there's recovery play there still. I know in our name that we've still seen it, and ours is not publicly traded, so it doesn't trade by buy and sell things. It's valued by independent appraisals. So Cushman & Wakefield values our assets, and every quarter we've seen it go up, and we believe there's more for it to go up just because real estate is doing well. The other sectors that are not doing, office is the big one right now, right? So people don't know how to play with that. It looks like you're in an office, I'm in an office. Some of us are in offices. A lot of people are not, right? There's a lot of offices right now where the tenant is paying the rent, but there's no one going in. The outcome is unknown. Will we go back to offices in the same way, or will we have these hybrid workforces? And I think what we'll see, and this is just me speculating, and I'm a landlord of office buildings, and I've, obviously a tenant of office buildings. We use a hybrid work model here, right? So there's 5 of us who wanted to come into office. That's how we thrive. And there's another 15 of us that work remotely. And so we've had to utilize technology more. We got people in New York and Dallas and Portland and all over the place. And so I think there's in between, I think the era of large, monolithic headquarter buildings are probably going to die off, and you're going to see a lot more regional hubs. Like, a tech company could go and put 10,000 square feet in Nashville and Austin and, Boulder and different places where people want to live and they have lifestyles. And so they can come in 2 days a week and interact with colleagues and have technology, but then they can go home. I think we're going to see more of that. So I think office is overlooked, but I think office is still very risky. It could work. It could not work. We don't know yet. We're talking about the Delta variant. Will that cause things to happen again? Who knows? Malls are, another interesting thing here. The malls are all, the worthy malls are all publicly traded. Simon is an example. They got them. There are unworthy malls that are publicly traded, and those are suffering on the margin.
And malls correct me if I'm wrong, but malls had seen weakness before COVID. Yes. As well, correct, for many years.
And it's the Amazon effect, right? So I think the retail component that is sort of internet resistant, so quick service restaurants, the pharmacies, the Dollar Generals. Believe it or not, Dollar Generals have done really well through all this period of time because most of the Dollar Generals are in smaller markets, and people are going there for things that they can't get or they don't want to get on an Amazon, if you will. But the other categories, like a lot of the shopping that that we used to go to malls for, we're not doing that now. We're just getting it delivered on our door, right? So I think internet resistant retail is going to have a lot more legs. That said, the yields have come down. I mean, I've seen CVS's and Walgreens that are trading, in line with corporate bonds, right? Because they're in so high demand.
And when you talk like internet resistant retail, is that sort of where net lease comes into play, where the tenants of that real estate, when they can control what exactly is there and sort of build for the future, that helps provide security?
Yeah, so net lease retail assets. So net lease actually has, the net lease is a type of lease, right? So it's a long-term lease with a single tenant, and it can be in an office, industrial, or retail asset. So the retail sort of net lease assets are going to be, like, for instance, we just bought a Raising Cane's in San Antonio. Raising Cane's drive-through. It's going to be resistant. You can't order Raising Cane's on Amazon, right? And it's going to be there, and it's going to serve the immediate needs of those people, the high school students, the hospital workers, right there. That's internet resistant. It's on a long-term lease. Who your tenant is. It's Raising Cane's. That's an example. A Walgreens, CVS, as I mentioned before, great. The ones that are a little bit trickier and it doesn't mean they're bad, but you have to be a little bit careful, are like the auto zones or these other types of things that do. One, are we still fixing our own cars? And two, can I not just go order these online, right? Mm-hmm. Those are the things where it comes into play. So that, yes, net lease assets that are internet resistant, net lease retail assets that are internet resistant are the ones that we try to own.
Okay, awesome. And I love that you just said that, because one of my largest stock holdings is actually carparts.com. But a different discussion.
Right.
One more question, Aaron. I'm getting word that we're out of time, but could you just give us a little bit of context into the Motive investment vehicle and what the experience is for investors? Yeah,
Motive is actually only one of its kind. It's a crowdfunding company, but it's also a REIT. So you own the fintech when you buy shares in Motive. We own, as I mentioned, in nearly $500 million of commercial net lease assets. So we're producing income every day. But we are publicly filing, so you can go and get us. You go to Edgar on SEC and you can look at our Qs and Ks. When you invest, you can invest for as little as $1,000. You're going to get monthly dividends paid to you. You're going to have quarterly share price changes. You're going to have access to high quality commercial real estate located across the United States. It's pretty easy investment experience. I think the play for us here is not only just real estate, but also the evolutions of crowdfunding and how that might create more value than just the real estate itself.
Okay. And can you talk a little bit more about what liquidity looks like for investors pre-listing?
Yeah. So the way we're no different than, say, Blackstone's REIT or other ones out there. So what it is, real estate is obviously illiquid. You can't just buy and sell real estate on a daily basis. So people come in. We balance the future needs of people who are coming in and people going out. And so if we have cash available, then we'll redeem you that month. If we don't have all the cash available in that month, then we'll redeem 15 or 20%, and then you'll have each month you'll be able to get it out. So over the last year, we've had certainly people who wanted to rotate out of real estate into other sectors, and they were able to get their money out. And so it's an ongoing thing. It's a process you have to manage but the unique thing about it is you have price stability, right? So if I had 10% of my investor base who wanted to sell in the stock market, my stock would sell off, right? Yep. If I have 10% here, I can meter them out and it's still at the same price. So it reduces the price volatility and you get the thing. But it's liquidity that is available, not on any given day. You can have some, but it's not 100% liquidity like you have in a publicly traded. That's why we want to list. Ultimately, we think long-term real estate is a listed vehicle. It starts out and then it grows and then it lists because of the need for people wanting liquidity to own real estate. Their objectives change. And that's why a permanent capital vehicle like a listing makes sense.
Awesome. All right, Aaron. I appreciate you hopping on with us twice in one day.
Thank you, sir.
Aaron Halfacre coming to us from Motive. Awesome discussion. I appreciate you walking us not only through some investing principles that you learned throughout your career, but also helping us go through that journey of, hey, I want to make a step towards real estate. So thanks a ton for joining us, Aaron.
Luke, thank you. Thanks, everyone.
All right. Take care.